What if I told you the single most famous piece of investment advice is also the most destructive? You've heard it a million times, right? Warren Buffett's legendary mantra, be greedy when others are fearful, is etched into the mind of every investor. It's the holy grail, the contrarian's battle cry. It's plastered across books, seminars, and every market crash. We all nod our heads like, yep, that makes sense. Buy when there's blood in the streets. Simple. But here's the uncomfortable truth. For most people who try it, this advice is a trap. It's a siren song that lures them straight onto the rocks of financial ruin. Because hearing the words is easy, but actually acting on them in the chaotic, stomach churning reality of a market meltdown, that's one of the hardest things you will ever do. Most will fail. They'll hear, be greedy, but they'll only feel the ice cold grip of fear. They'll see what looks like an opportunity, but be paralyzed by headlines screaming, crash. In this video, I'm going to break down exactly why this advice backfires for so many. More importantly, I'm giving you the step-by-step blueprint that separates the few traders who build generational wealth from the masses who get wiped out. This isn't about slogans, it's about a system. This is the trader's blueprint for turning widespread panic into personal profit. Let's just cut to it. The idea of buying when everyone else is selling sounds heroic. It sounds smart. But when that moment of truth arrives, your own biology will scream at you to do the exact opposite. Your brain treats a massive financial loss with the same primal alarm as a physical threat. When your portfolio is bleeding out, down 20, 30, or 40%, the rational part of your brain gets hijacked by raw, uncut fear. This isn't a character flaw. It's just human nature. It's a psychological trigger called loss aversion, the principle that makes losing $100 feel twice as painful as gaining $100 feels good. The herd mentality kicks in, telling you that if everyone is running for the exit, you'd be a fool not to join them. You see headlines predicting the next Great Depression, and your brain convinces you the downward spiral will never end. This is the moment. This is the moment where wealth is either transferred or created. Most people become victims of this moment. They panic sell, turning their paper losses into permanent, real world financial pain. They trade their future for the temporary relief of making the anxiety stop. But a small few, the prepared few, see this moment not as an end, but as a beginning. They see the greatest sale on earth. This video is about how you can become one of them. To really understand how to pull this off, we can't just talk in hypotheticals. We need to travel back to a moment of pure global panic. We need to dissect it, the emotions, the headlines, and the opportunity it created. And there is no better example than the COVID-19 crash of March 2020. Let's set the scene. It's early 2020. The market was roaring. The S&P 500 had just hit a new all-time high. The CNN Fear and Greed Index, a tool we'll get into later, was flashing extreme greed. It felt like the party would never end. Sure, there were whispers of a virus in a distant city, but for most of us, it was just background noise. The bull market seemed invincible. Then the noise became a roar. By late February, the virus wasn't a distant problem. It was in Italy, it was in the US, and the word lockdown officially entered our vocabulary. The market's reaction wasn't a correction, it was a collapse. Between its peak on February 19th and the bottom on March 23rd, the S&P 500 lost a staggering 34% of its value. This wasn't a slow grind, it was the fastest, most brutal fall from an all-time high in financial history. Days where the Dow dropped 2,000 or 3,000 points became terrifyingly normal. What did that feel like? Sheer terror. The headlines were apocalyptic. Worst crash since 1929. Global economy grinds to a halt. Every news channel, every website was saturated with fear. The financial world, so robust just weeks before, seemed to be on the brink of collapse. This is where our blueprint begins, measuring the fear. While the world was panicking, pros were looking at their dashboards at objective indicators. One of the most important is the VIX, or the CBOE Volatility Index. It's called the fear gauge for a reason. A VIX reading below 20 is calm. Above 30 means fear is creeping in. In March 2020, the VIX exploded. It surged to a closing high above 82, a level not seen since the absolute depths of the 2008 global financial crisis. It was a number that represented pure panic. At the same time, the CNN Fear and Greed Index, which had been so greedy just weeks before, completely cratered. On March 12th, 2020, the index hit a reading of just 1 out of 100. That's the lowest possible score. It was a measure of absolute rock bottom extreme fear. This data, a VIX over 80 and a fear and greed index at 1, wasn't a signal to run. For the prepared investor, it was a screaming, once in a decade buy signal. The fear wasn't just a feeling, it was measurable, and it was at its absolute peak. So, what happened? Most investors did what their instincts screamed at them to do. They sold. They couldn't stand the pain anymore. And in doing so, they locked in catastrophic losses at the worst possible moment. But the contrarians, the ones with a plan, they saw the world's greatest companies on a 34% off sale. They had their watch lists ready. And as the panic sellers dumped their high quality stocks, the contrarians stepped in and calmly started buying. The recovery was just as shocking as the crash. After bottoming on March 23rd, the market rocketed upwards. By August 2020, just 5 months later, the S&P 500 was already hitting new all-time highs. The gains for those who bought near the bottom were life-changing. Now, not every stock bounced back perfectly, but let's look at some standout examples. Wayfair, the home goods company, thrived in the stay-at-home world. Peloton saw its stock surge as gyms closed down. Moderna, a biotech company few had heard of, became a household name and a huge winner. Even blue-chip giants offered incredible returns. Big tech and companies enabling the work-from-home economy soared. And so-called recovery plays like MGM Resorts or Gap, which were left for dead during the lockdown panic, delivered stunning returns for anyone who bet on a return to normal. This wasn't luck. It was about having a system. It was recognizing that the moment of maximum fear is the moment of maximum opportunity. The lesson is brutal but clear. Fortunes aren't made by following the herd. They're made by having the courage and the plan to bet against it. So the question is, how do you build that plan? Part 2, the trader's blueprint. What we saw in the 2020 crash was the what. Extreme fear creates a generational buying opportunity. Now we get to the how. This is the practical 4-step framework you can use to prepare for the next market panic. It's not a get-rich-quick scheme, it's a discipline. This is the trader's blueprint. Step 1, identifying and quantifying extreme fear. Rule number 1 of being greedy is to know, objectively, when fear is actually in the driver's seat. Your feelings will lie to you. Headlines are designed to make you panic. You need cold, hard data. The goal is to replace that feeling of anxiety in your stomach with objective, data-driven signals. There are 3 key tools for this. First, and this is the big one, is the VIX, the CBOE Volatility Index. Think of it as a fear thermometer for the market. VIX below 20, complacency. The market is calm. This is not the time to be greedy. VIX between 20 and 30, nerves are showing. VIX above 30, real fear is setting in. VIX above 40, extreme fear and panic. Historically, readings above 40 have marked fantastic long-term buying opportunities like in 2008 and 2020. Your job isn't to watch it every day. It's to set a mental alert. When you see the VIX is surging past 40, that's your signal to start paying very close attention. Second is the CNN Fear and Greed Index. This is a broader sentiment indicator that combines 7 different factors into one simple gauge from 0 to 100. Reading it is dead simple. 0 to 25 is extreme fear. This is your green light. 75 to 100 is extreme greed. When the market is euphoric, you should be fearful. When this index plunges into the single digits, as it did in March 2020, it's a powerful sign that the sellers are exhausted. The third tool is the put-call ratio. This simply measures how many bearish bets, put options, are being made versus bullish bets, call options. A high ratio, especially above 1.0, means more people are betting on a decline. As a contrarian, you see this differently. When it feels like everyone has already placed their bet on the market going down, it often means there aren't many sellers left. A spike in the put/call ratio is a classic sign that the market is washed out and a bottom may be close. By combining the VIX, the Fear and Greed Index, and the put/call ratio, you build an objective dashboard of market sentiment. You're no longer guessing if there's fear, you're measuring it. When the VIX is over 40 and the Fear and Greed Index is under 25, the data is giving you an unambiguous command: get ready to be greedy. Step 2, the contrarian's watch list. Being greedy doesn't mean blindly buying anything that's down. Panic drags everything down with it, the good, the bad, and the bankrupt. Your job is to use the chaos to buy great companies at good prices. This requires homework. The middle of a crash is the absolute worst time to start figuring out what to buy. The time to build your shopping list is now. This is your Contrarian watch list, a curated list of the highest quality companies you'd love to own if they ever went on a massive sale. So, what makes the cut? You're looking for resilience and quality, a fortress balance sheet. In a crisis, cash is king. You want companies with low debt and lots of cash. They can survive the storm, and while their weaker competitors struggle, they can go on the offensive, gaining market share. A durable competitive moat, a term Warren Buffett loves. It's a company's ability to fend off competitors. This could be a powerful brand like Apple, a network effect like Amazon, high switching costs like Microsoft, or a low cost advantage like Costco. Companies with wide moats are built to last. Proven leadership. Invest in management teams with a track record of navigating tough times. A great business with bad leadership is still a terrible investment. Secular tailwinds. Look for companies riding long-term trends bigger than any one economic cycle. Think of shifts like artificial intelligence, renewable energy, or healthcare innovation for an aging population. A crash might dent these companies, but the long-term trend is a powerful wind at their backs. How do you find them? Start with what you know. Which products and services do you use and admire? Look at industry leaders who dominate their sectors. Use stock screeners on your brokerage platform to filter for companies with low debt, strong cash flow, and other signs of quality. Study the holdings of successful long-term investors you respect. Your goal is a focused list of 25 to 50 names you know inside and out. This list is your playbook. When the market panics and your fear signals start flashing, you won't be scrambling. You'll just open your watch list and get to work. All right, we're about to dive into the most critical part of this blueprint, exactly how to start buying during a crash, and just as important, how to master your own psychology so you actually follow through. This is where theory becomes action. If you're finding this valuable, take 1 second to hit that subscribe button. This channel is all about giving you clear, actionable strategies, and you won't want to miss what's coming next. Now let's talk about how to deploy your cash. Step 3, the entry strategy, a scaled approach. You've measured the fear. You have your watch list. Now it's time to execute. This is where most people freeze, paralyzed by one question. But what if it drops more? They try to time the exact bottom, which is impossible, and the wrong goal anyway. Even Warren Buffett, in his famous Buy American, I Am op-ed during the 2008 crisis, couldn't time the bottom. He publicly announced he was buying stocks in October 2008, and the market proceeded to fall another 20%. Did he panic? No. His goal wasn't to be perfect, it was to buy good assets at a good price. To avoid this paralysis, you need a system. The most effective method is scaling in, buying a little bit at a time as the market gets cheaper. This does two powerful things. It takes the emotion out of it. You're no longer trying to catch a falling knife, you're just following your plan. It ensures you actually do something instead of just watching from the sidelines in fear. Let's make this super practical. Say you have $10,000 in cash saved for a correction, and you want to buy a great stock from your watch list that was trading at $100. Your predefined plan could look like this. Trigger 1, down 20%. The stock hits $80. You deploy your first $2,500. Trigger 2, down 30%. The stock falls to $70. The fear is rising, but you stick to the plan. You deploy your next $2,500. Trigger 3, down 40%. The stock is at $60. The headlines are awful. Your fear indicators are flashing red. This is the moment. You deploy another $2,500. Trigger 4, down 50%. The stock hits $50. This feels like the end of the world, but your system was designed for this exact moment. You deploy your final $2,500. So what just happened? You invested your full $10,000 and you own over 158 shares. Your average price isn't $100 or $80. It's about $63 per share. When the market recovers and the stock goes back to $100, your $10,000 investment is now worth nearly $16,000. You made a 60% return by buying the fear. This isn't a hypothetical. This is how wealth was built in 2008 and 2020. The key is to define your triggers in advance. Write them down. A mechanical approach is your best shield against the chaos of a market crash. Step 4, the psychology of a contrarian, mastering your mind. This is the final and, frankly, the most important step. You can have the best plan in the world, but if you can't control your own mind, you will fail. Being a true contrarian is less about finance and more about psychological fortitude. Here's how to build that mental strength. Go on an information diet. During a crash, the media becomes a fear engine. Sensational headlines are for clicks, not sound advice. You have to limit your exposure. Turn off the noise. Don't watch the market tick by tick. Trust your data and your system, not the talking heads. Reframe fear as opportunity. You cannot control the market. You cannot control the economy, but you can control your actions and your mindset. A market crash is not a threat to your wealth. It is the opportunity you've been waiting for to build it. Every headline screaming sell is for you a quiet whisper saying buy. Study market history. Confidence comes from context. When you're in a crash, it feels like it will never end. That's why you have to study past crashes. 2000, 2008, 2020. Every single time the panic ended, and every single time the market recovered to new all-time highs. History is the ultimate antidote to short-term fear. Find your people. It is incredibly hard to stand alone against a stampeding herd. Find other like minded long term investors. A small group to reinforce your discipline can be an anchor in an emotional storm. Know why you own what you own. This goes back to your watch list. Your conviction can't be borrowed, it has to be earned through your own research. If you truly believe in the business you're buying, a price drop after you buy isn't scary. It's exciting. A chance to buy more at an even better price. Mastering your psychology is the final layer of armor. It's what allows you to execute your plan with the cold discipline of a professional while the world around you is burning with fear. Let's bring it all together. The advice to be greedy when others are fearful is easy to say and incredibly hard to do. It goes against every survival instinct we have. Following the herd and panicking is the default setting. It's the path of least resistance, and it leads directly to the destruction of wealth. But today, you've been given a different path, a blueprint. It starts with step one, quantifying fear, where you stop listening to your anxiety and start watching the data from tools like the VIX. Then you move to step two, the Contrarian's watch list, doing your homework ahead of time so you know exactly what high quality businesses you want to buy. Next is step three, the entry strategy, where you use a scaled approach to systematically buy into the panic, turning volatility into your friend. And finally, step four, mastering your psychology, building the mental fortitude to see the plan through when every instinct is telling you to run. On a much larger scale, this is how the biggest and best investors operate. They use sophisticated models to exploit the volatility that fear creates. They see panic selling not as a crisis, but as an opportunity, deploying capital systematically when others are desperate to get out. The principles are identical. Use fear as your signal, buy quality at a discount, and maintain discipline. The next crash will come. It might be next year, it might be in 5 years. The headlines will be different, but the human emotion will be exactly the same. Fear will grip the markets, people will panic, and a massive transfer of wealth will happen. The only question is, which side of that transfer will you be on? Will you be the one selling your future for a moment of relief? Or will you be the one with a blueprint in hand, calmly building the foundation for life changing wealth? The choice is yours. The fear is a given. The opportunity is guaranteed. The preparation starts now.